Uncontrollable limited leverage, UL, Part 1. Why is ULL so important? To accumulate financial wealth, you need to attract large sums of money. To attract large sums of money, you need two things: 1. Control. And 2. Leverage. The slow lane has neither, and that truth is exposed when you reverse engineer the strategy into its mathematical equivalent or its wealth universe. Uncover the mathematics behind the plan and you uncover its weakness. When the slow lane is deconstructed, you find two variables: 1. The primary income source, which defines how income is earned, and 2. The wealth accelerator, which defines how wealth is accumulated. The slow laner's primary income source comes from a job, while the wealth acceleration vehicle comes from market investments like 401 Burmese chats and mutual funds. Put it together and you arrive at the slow laner's wealth equation. Wealth equals job plus market investments. The primary income source, the wealth accelerator. Under this plan, income from a job funds both lifestyle and market investments. However, to uncover the prohibitive ULL within the plan, we have to factor these variables further, starting with the job variable. The warden of wealth, intrinsic value. How is money earned in a job? Intrinsic value. Intrinsic value is determined by the marketplace and is the price at which you can trade your time for money. Intrinsic value is what you earn working a job. How much is someone willing to pay you for what you offer to society? Intrinsic value is measured in units of time, either hourly or annually. If you're paid $10 per hour to flip burgers at the neighborhood grill, your intrinsic value is $10 per hour. If you're an accountant and earn a $120,000 annual salary, your intrinsic value is $120,000 per year. Job intrinsic value equals hourly rate of pay times hours worked. Or job intrinsic value equals annual salary. Notice that intrinsic value is measured in units of time. This time attachment introduces the slow lane's first punitive element of wealth creation. Can you control time? Can you leverage time? You can't. Your time is limited to 24 hours of exchange. If you earn $200 per hour, you can't miraculously demand to work 400 hours in one day. If you earn $50,000 per year, you can't miraculously demand to work 400 years in your life. Time has no leverage. For the hourly worker, your maximum upper limit is 24 hours, and guess what? There's nothing you can do to change this limit. In theory, you can trade 24 hours of your day for income, but you can't trade more. Of course, working 24 hours a day is humanly impossible, so 8 to 12 hours per day are traded. For the salaried worker, the prohibition is the same. You can't work more years than your normal life expectancy. What is the upper limit of this exchange? 40-50 years? In all of recorded history, no human has ever worked 10,000 years of his or her life. Whether you're paid hourly or annually, it doesn't matter, you can't leverage time. Consider this. Is 12 a large number? Or 50? Are these numbers predisposed to create millionaires? They aren't, and it exposes why the mathematics of a job are wealth punitive. Your time is limited to small numbers and cannot be leveraged. Hours worked or an annual salary are mathematically inept because they're based on time measurements that cannot be controlled or manipulated. Mathematics doesn't lie, 12 will always be less than 10 million. If leverage is limited, so is wealth creation. Small numbers do not make millionaires. Behind limited leverage is another corrosive wealth killer: no control. Can you control your employer? Can you control your salary? Can you control the economy? Can you earn $50,000 one year and next year bank $50 million? Can you control anything about your job, including your measly 4% pay raise? You might think you can by job hopping, but you can't. Control is weak if not absent. Compound interest, what they don't tell you. The second variable in the slow lane wealth equation is the primary wealth accelerator, which comes from market investments like mutual funds, 401 Burmese chats, and other traditional investments touted by gurus and financial advisors. These investments use the financial strategy known as a compound interest, which is a mathematical construct that outlines the power of interest accumulation over great periods of time. The fundamental sell of compound interest is the old guru swan song regurgitated ad nauseum: $10,000 invested today will be worth gazillions in 40 years. Invest $250 a month for 50 years and you will retire rich. Used correctly, a compound interest is a powerful ally to wealth, used for slow lane purposes, and it dredges the wealth road trip to a crawl. Why? Again, the puzzle is solved if you exploit the math. The answer plays sibling to why a job won't make you rich: time. Wealth creation via compound interest requires the passing of time and lots of it. Like a job, compound interest, or market investments such as mutual funds and 401 Burmese chats, can't be leveraged nor can they be controlled. They rely on deficient math to create wealth. Inasmuch as the income you make in a job is measured in an hourly rate or an annual salary, the wealth acceleration process of a compound interest is also measured in time, years, multiplied by a yearly yield. Let's again review the physics, the mathematical formula for the slow lane pathology to wealth. Wealth equals job plus market investments. The primary income source, the wealth accelerator. Or factored. Wealth equals intrinsic value yearly plus compound interest yearly. The primary income source, the wealth accelerator. Factored further. Wealth equals time times hourly or salaried value plus invested sum times 1 plus yield time the primary income source, the wealth accelerator. Like a job, the flaw in a compound interest lies in the same mathematical restrictions in which numbers work against you instead of for you. Take a look at this chart, which highlights the effect of compound interest and that $10,000 investment. A slow lane guru preaches that a $10,000 investment grown at 15% will be worth over $2.5 million in 40 years. Hooray! What don't they tell you? They don't tell you that a 15% return year after year is impossible unless you invest with Bernie Madoff or Charles Ponzi. They don't tell you that in 40 years you'll be dead, and if you're not, you'll be close. They don't tell you that in 40 years, your $2.5 million will likely be worth $250,000 in today's dollars and that a gallon of milk will cost $12. They don't tell you that this method of wealth acceleration is not what they use. They don't tell you plenty. And yet you're supposed to believe it without question. Uncontrollable limited leverage, YUL, Part 2. For compound interest to be effective, you need 3 things. 1. Time as measured in years. 2. A favorable yearly investment yield within those years. 3. An invested sum repeatedly invested. These 3 variables make up the latter portion of our slow lane wealth equation. Compound interest equals invested sum times 1 plus yield time. Although this is a simplified version of a more complicated equation, the point of this analysis is its variable components. Compound interest demands that your investments yield a predictable 10% return per year. Good luck with that 40-year gamble. Have the markets ever lost 20% in 1 year? Or 40%? They have, and when they do, your hard-earned savings evaporate. You see, wealth acceleration via compound interest is deficient because its variables are deficient. Neither time nor yield can be leveraged or controlled. Again, meet my friend uncontrollable limited leverage. Can you demand a 2,000% return on your money this year? Can you demand your investment time horizon increase from the standard 40 years to 400 years? Again, the numbers can't be leveraged. Your upper limit of time investment horizon is 50 years. Yield is worse. A 6%, 8%, or 10% yearly investment returns are typical standards. Time is restrained by the years in your life, yield is restrained by the average yield of typical market investments, and sum is limited because your means of creating income comes from a job, also limited. The only way to subvert the mathematical weakness of compound interest is to start with a large number, and large numbers require leverage. Additionally, like a job, you can't control compound interest. Can you demand your bank pay 25% interest on your savings? Hey, Mr. Slowlane Bank, I demand a 25% yield on my savings account. Can you control the economy? Hey, Mr. Economy, can you guarantee me low unemployment and a business-friendly tax environment? Can you control the average yield of the stock market? Hey, Mr. Stock Market, I'm tired of 8% returns, can you give me 250% this year? Funny stuff. Can you control anything in this equation other than a furious, labor-intensive search for the best investments to ensure you eke out another marginal 1%? You can't. Why mutual funds and 401ks won't make you rich in 2008, I went to a fixed income investment seminar given by a major brokerage house. Fixed income investments are instruments like municipal and corporate bonds. Approximately 50 people attended the standing room-only seminar. I sat in the back and surveyed the crowd. Remove the gray hair, the socks and sandals. Combos, the canes, and the wheelchairs, and what was left? Just me. I was the youngest person in the room, and heck, I'm not even that young anymore. How does a 30-something get in a room full of retirees? The people in the room were SlowLane success stories. They used time to accelerate wealth, and what it got them was old age. I don't say that to be mean-spirited to older generations, but to cast light on the point, compound interest, 401 Burmese chats. Mutual funds, the stock market, cannot accelerate wealth fast. According to research and marketing firm the Harrison Group, harrisongroupinc.com, only 10% of pentamillionaires, net worth $5 million, report that their wealth came from passive investments. Age data was not provided, but you can guess that none of the 10% were under 30. Think about it. Have you ever met a college student who got rich investing in mutual funds or his employer's 401k? How about the guy who bought municipal bonds in 2006 and retired in 2009? I wonder if that guy driving a $1.2 million car can because of his well-balanced portfolio of mutual funds? These people don't exist because the youthful rich are not leveraging 8% returns but 800%. Has your wealth ever grown by 800% in 1 year? Probably not, but guess what? Mine has, because I'm not shackled to the SlowLane wealth equation. My wealth acceleration vehicle doesn't come from the stock market. Yet you've been domesticated to believe that these tools accelerate wealth. Mutual funds, stocks, bonds, 401 Burmese chats, dollar cost averaging, and compound interest are perfunctory stratagem for wealth acceleration in the SlowLane. Unfortunately, without control or leverage, they're impotent wealth accelerators. Buy and hold is dead. In college, I was taught buy and hold was the safe investment strategy that made millions. Buy stocks in solid companies, sit back and wait decades, and voila, I'd be awash with millions. They'd shove that graph in your face and say gay. $10,000 investment in XYZ Company in 1955 would be worth $5 million today. Thankfully, I ignored it. In 1997, I opened a Roth IRA with $1,000 and invested the monies in a growth mutual fund at a major investment firm. Yes, I let the professionals manage it for me. For the next decade, I didn't touch it. Essentially, I forgot about the account. In the 10 years that followed, I made over $10 million by following a FastLane roadmap and leveraging FastLane strategy.